Good afternoon, everyone. Welcome to our first Money Mondays with Melissa for 2023. We have a few housekeeping items to cover before we begin. The first of which is to let you know that we are live for today's Money Mondays, which will be available for viewing on demand after this session has been completed. Everyone who registered to attend will receive an email with a link to the recording. All participant lines are muted. So if you're having any technical issues, please use the chat feature to let our team know, and we will try to assist you. We encourage you to use the same chat feature to submit any questions or comments you have during today's presentation. We'll collect the questions and try to address as many as possible during the Q&A portion of today's session. Any questions that we're unable to address will be shared with today's speaker, whose staff will follow up with you via email. So now we will turn our Money Mondays with Melissa over to Michelle Kuipers from Ladder Up. Michelle, welcome, and you're live.
Thank you so much. Thank you to Melissa and everyone at the Treasurer's Office for all the help setting this up. My name is Michelle Kuipers. I'm from Ladder Up. We're a nonprofit that deals with financial literacy and taxes. So we're going to talk a little bit about tax tips for seniors, a little bit about changes to the taxes for 2022. And then we're also going to tell you about some of the great services that we have through Ladder Up that you might want to access that are available to you for free. So it's going to be an exciting presentation today with a lot of stuff in it. So let's get started. If you've never heard of Ladder Up before, I mentioned we're a financial services organization, and we're kind of an all-encompassing financial services organization. So our biggest program that you may have heard of before is the Tax Assistance Program. This is where we prepare taxes for free at, we have 11 sites all around Chicago and the Chicagoland area this year. For families, the income threshold for those in-person sites is $60,000. For individuals, it's $32,000. We also are happy to have an online program this year that has a little bit higher income thresholds, and we'll tackle that in a couple of slides. We also have our tax clinic. This is where I work at Ladder Up as our staff attorney. It helps individuals and families who have controversies with the IRS or the Illinois Department of Revenue. So if you ever get a letter and you need help, we are able to help you with that. And then finally, we have our financial literacy program, which has 2 tracks, a college success track where we help with the FAFSA application or the alternative application in Illinois. We help with student loan awards and understanding student loan letters. If anyone ever gets examined, their FAFSA gets examined or audited, we help with that as well. And then we have an adult literacy track where we cover topics like budgeting, banking, retirement, savings, credit building, those types of workshops. So lots and lots of options through Ladder Up for any of your interest areas. But let's talk more in detail about our tax assistance program. Through our tax assistance program, free tax preparation, electronic filing, so that way it gets to the IRS as soon as possible and you get your refund as soon as possible. We do federal and we do Illinois taxes. Both for free, unlike maybe some of the online services where one is for free and one is paid. We do both for free, and we help maximize credits. So we have volunteer staffing at our tax sites, and they are all trained through IRS training programs to be able to get you the most refund and the most credits that you qualify for. So I definitely urge everyone to use our tax assistance program. If you do not have the income, if you're over income, you're over that $32,000 for an individual or $60,000 for a family, we do have our online program, which is called ETAP, very original, Tax Assistance Program Express. So for ETAP, we also have the luxury of covering previous years. So we are preparing 2022, 2021, and 2020 taxes through ETAP. Just because we can have a little bit more bandwidth through the online. And our household income, doesn't matter if you're a single filer or a family, a household income is $73,000 for ETAP. And this can be found through our website, goladderup.org, or scanning the QR code that you see on the screen. The other benefit of ETAP is if maybe you worked in Wisconsin or you worked in Indiana, or you have friends or family in different states, our ETAP program can prepare any state return for free in addition to Illinois returns, or any state return and not Illinois returns. So feel free to let other people know about this option. We are limited to that rental income is not available through ETAP and business losses are not available through ETAP, but it is a kind of a new program for Ladder Up that we're really excited about. So we want everybody to utilize either our in-person sites or our ETAP program. The tax clinic is another one of our kind of hidden gem programs, and I'm only saying that because I'm in charge of it. But the IRS or Illinois Department of Revenue, if you are ever audited, if you're ever wanting assistance with understanding letters or notices that you might get, if you have a U.S. tax court case, this is something that we help with. We provide free legal representation on these issues before the IRS or Illinois or before the tax court. It's handled either by our in-house staff, myself and my paralegal, or it's handled by our team of pro bono attorneys, CPAs or EAs, who are all very familiar with these types of issues and can help you work through it. So if anything has happened with your taxes that you don't really understand or you're not very comfortable with, that is something we can help with. I've listed here a couple of the common ones, which is if you have a balance with IRS and you can't afford to pay it all at once, we can help with that with collection alternatives, audits, tax court, tax-related identity theft, which is actually pretty huge, and we can help resolve with the IRS. And then innocent or injured spouse, where one spouse owes a bunch of money from a previous year and their other spouse is not liable for it for whatever reason. We help with resolving that issue as well. Finally, again, our financial literacy program, helping students get to college through the FAFSA and the Illinois alternative application, helping with the jump between high school and college. And even if you're in college and you need help understanding some of the things you've signed up for. And then our adult literacy check, lots and lots of people interested in how to build credit, how to save for retirement, house planning, if they want to buy a house, things of that nature. So we have a lot of resources on our website, but I hope you look to Ladder Up or you keep us in mind if you ever have questions about any of these types of things. So let's get more into taxes. So the first question everybody asks, the question I get on the phone quite a lot is, do I have to file? Who needs to file? Do we all have to file? And the answer is no, even if that makes it maybe a little bit more confusing. If the answer is no, not everybody has to file. And whether you have to file or not depends on your filing status and the state of your household, right? So there are 5 filing statuses. You have to pick one of them each year. There's single, head of household, married filing jointly, married filing separately, and qualifying widower with dependent children. This is also sometimes referred to now as qualifying surviving spouse with dependents. Some of these have restrictions on who can qualify. And I think the biggest confusion that people often have is single versus head of household. Single doesn't mean you don't have a significant other or boyfriend or girlfriend. Single means you are not legally married. And head of household doesn't mean that you pay all your bills. If you are an individual living alone and you pay all your bills, even though we all might think I am the head of my household if I live that way, for IRS purposes, you can only claim head of household if you have a qualifying dependent, which means that you have kids in the house or a family member who lives in your household and relies upon you. So keep that in mind. If you don't have any dependents and you are not legally married, you are likely filing as single. If you have dependents and you're not legally married, you might be filing as head of household. If you're married, there are really only 2 statuses available to you: married filing jointly and married filing separately. There's some exceptions there, but very few. And then qualifying surviving spouses only applies for 2 years after one of the spouses dies in a marriage. So if you look though, after picking your filing status, it then comes down to age. 65 is the magic number for the IRS. Under 65, one set of rules applies to you. Over 65, a different set of rules applies to you. So if you want to look, the minimum wage requirement, and when I say W-2 income, I mean if you have a job that you receive a W-2 from at the end of the year, the minimum W-2 income requirement for filing, if you're single and under 65, $12,950. And if you kind of glance down the list, that one is for the most part the lowest. So if you're keeping in the back of your mind $12,900, if I made less than $12,900, I probably don't have to file. If you're older than 65, you could still think 12,900 because you get a little bit of a bump to 14,700. And it varies based on those filing statuses because the IRS likes to give a little bit more extra wiggle room if you have dependents or if there's multiple people in the household, like a married filing jointly. You'll notice that there is no wiggle room for married filing separately. That's $5. So married filing separately is a filing status that sometimes people need to utilize, but we don't usually recommend it if it can be avoided because it doesn't have a lot of benefit. And then that's all for wage earners. We'll talk about Social Security on the next slide. But you see here on the right, self-employment income. This is any sort of income where you're going to receive a 1099, or if you're doing gig work for Uber, DoorDash, any of the apps, if you're getting a 1099 at the end of the year, or if you have your own business, that's self-employment income. And you'll see that's an easy one to remember, straight shot down the list, $400. If you earn more than $400, you need to file if you have self-employment income or 1099 income. But yeah, what about Social Security? What if I have Social Security? What's my filing requirement? With Social Security, it gets a little bit more complicated because when you have Social Security within a certain range, it's not taxable. So if you have Social Security within that non-taxable range, and that's all you have on your tax return, you don't have a filing requirement. You do not have to file your taxes unless you're doing it for other reasons. So what is that range? The easy way to remember is less than $25,000. If your Social Security benefits are less than $25,000 and you have no other income, you're not taxable. But you can see it gets a little bit more mathy, everyone's favorite thing, math. If half of your Social Security benefits, and then maybe you're working a job, a 1099 or something, and then you add your total benefits or your total income to your half of your Social Security benefits, and it exceeds 25,000, suddenly certain amounts of your Social Security become taxable, as well as that total other income if you're coming with other income while you're retired. But only half of your Social Security benefits. It's not treated the same way as wage income. And it's not treated the same way as self-employment income. So judging by a filing status, and at least this way you have married filing jointly and you have everybody else, you can determine whether your Social Security your Social Security benefits are going to become taxable. And if your Social Security benefits are taxable, then you need to file your taxes to determine what that tax amount is and whether you've already paid it. So keep in mind, I would say the magic number to keep in mind, $25,000. If your Social Security benefits exceed that, or if your household income exceeds that, plus Social Security, you're going to have to start looking into whether you're going to be taxable and whether you're going to need to file. So keep that in mind. And this applies to retirement income, so survivor benefits and disability benefits. It does not apply to SSI, supplemental security income. Supplemental security income is never taxable, and they don't send you a form at the end of the year. So all of this applies to those types of benefits listed at the bottom. It does not apply to supplemental security income or SSI benefit. So maybe we've gone through this and you think, well, I don't meet those requirements. I guess I don't have to file. I don't make that much. There are certain circumstances where maybe you do not have a filing requirement, but you may want to file your tax return. I've got some examples here. This is not the end all be all list, so you'll have to treat it with your specific situation. But if you are going to receive back your withholding in the form of a refund, or if you're going to receive tax credits that might be refundable to you, we recommend, even if you don't have to file, that you file so that you can get that refund back. And this will be withholdings from a job, child tax credit if you have children in the household who qualify, earned income tax credit if you earned a little bit of income for the year, premium tax credit, which applies if you had marketplace health insurance through the healthcare.gov marketplace. And then if you are going to college or someone in your household is going to college, you may qualify for education credits, some of which might be refundable. So we recommend you file if you normally would not have to, but you have any of those possibilities. Some social services agencies required tax returns, and some court matters like immigration require tax returns. Sometimes even if you don't have a requirement, It's easier to just file your zeroed out tax return and have it available to provide if you do need to provide it. And then student loan repayment programs also, the easiest way to determine whether you need to be paying on that as we move into the time when student loans become repayable is to have a tax return on file with the IRS that you can just click yes, student loans, go ahead and pull that tax return and you can see my income. And then finally, keep it in the back of your head, that $400. If you did some gig work on the side, you had a 1099 for $400, you earned self-employment income, and you didn't withhold your taxes, or you did withhold your taxes, you're going to have to file. So keep that in the back of your mind. Speaking of self-employment and not withholding taxes, let's talk about possible reasons why somebody might owe on a tax return. Because a lot of times we get people who come to the end of the process and maybe they might have a balance and their response is, I don't know how this happened. So let's talk about why it might have happened. The first and the foremost reason why somebody might owe on their taxes is if they didn't withhold enough from their paycheck. This could either be because they filled out the forms when they got the job wrong, or that, employers are not able to give guidance on that. So some people are kind of just like, I don't know, I'll put whatever. Or they were counting on tax credits that they may not qualify for anymore. So those are reasons why somebody may not be withholding enough from their paycheck. And I like to explain withholdings as you're prepaying your taxes to the IRS. Each time you get a check, you prepay a little bit of taxes. And that way at the end of the year, not only have you fully paid your taxes, but if you prepaid too much, you get it back. So if you are if you're owing every single year on your taxes and you really don't know why, my best advice to you is to request a W-4 form from your employer, W-4, and refill it out. That form has changed in recent years, so it might be a little different. If you have questions about that, you can reach out to Ladder Up and we can help you or point you to some guides for how to fill out that W-4 form. Another reason is some incomes people are not withholding from because they're assuming that they're not taxable. And whether they're taxable depends on your circumstances. So I'm not saying this is a blanket. Although I will say unemployment compensation, a lot of people in the past few years have claimed unemployment when they never have before. Unemployment is taxable income. That one is a blanket, and I will say it. Unemployment is taxable. So make sure you're withholding taxes from your unemployment so that you don't have to pay all those taxes all at once at the end of the year. As we talked about on the previous slide, Social Security can be taxable and people usually don't withhold from it. So if you're getting Social Security income and you think it might be taxable, maybe time to start trying to withhold from Social Security income. Some pension income is taxable. So make sure you're familiar with your pension or your retirement program and whether that income is taxable. And whether you need to withhold or prepay your taxes on that pension. If you're self-employed, making that gig work income, doing those 1099s at the end of the year, self-employment income is taxable and it's taxed at a different rate than wage income. Self-employment income is taxed at your normal rate, but it also has an additional tax on it called the self-employment tax. That is 15.3%, and it is split exactly. The 15.3% is split exactly by Social Security and Medicare payments. So that way, if you're young and you're self-employed, you're starting your own business, it allows you to build up that Social Security and retire when you reach the appropriate age. So self-employment income taxed at a higher rate. And if the IRS expects you to owe more than $1,000 on self-employment income at the end of the year, they like you to prepay it in the form of estimated tax payment. I won't dwell on this very much because I talk about this really extensively in some other presentations. If you are self-employed and you are curious about estimated tax payments and how you should be structuring for self-employment, please reach out to Ladder Up. We can point you towards some recorded presentations or we can help you work that out. And then finally, a big one is that penalties from withdrawing from retirement accounts before age 59 and a half. Sometimes people withdraw from a retirement account because it's an emergency. Sometimes that emergency is not the type of emergency IRS considers an emergency. And even though those are your funds, you have to pay your tax rate on those funds. And then you have to pay, if you're under 59 and a half, you have to pay extra penalty of 10% taxes for early withdrawal. So, and what happens a lot is people leave a job, they get some letters that maybe COBRA, maybe is something from the retirement, they don't know what to do because they've left the job, or they're started a new one, or they're on the job hunt, they don't have time to think about it, and they don't roll over their retirement funds from their old job. You have to roll over those funds into a new retirement account within 60 days to not get those withdrawal penalties. So once you leave a job, the best thing to think about in the back of your head, in addition to your new job hunt, is I need to make sure those retirement funds don't bite me with that bad penalty. So we see that one pretty often from people withdrawing or forgetting when they leave a job and not rolling over. Now, all of that, let's talk about the changes that just happened to 2022 taxes and what you might be wanting to expect while you're filing your taxes for 2022. The first and biggest change is that the 2022 child tax credit has really changed. So there are a couple of things for qualifying for the tax credit, but we're just going to cover some of those changes. The first one that's hitting a lot of people is in 2021, they raised the age limitation on the child tax credit to 17. In 2022, that maximum age is 16. If they are 17 as of December 31st, 2022, you no longer qualify for the child tax credit for them. There's another credit that they can qualify for if they're living at home called the credit for other dependents. It's $500, non-refundable, but they are not qualified for the $2,000 per child tax credit. The limit, speaking of the $2,000, the amount of the child tax credit has been severely reduced. If you'll remember the 2021 child tax credit, everyone was really excited. It was huge. It had all these new things like advance payments. That was all due to the pandemic from the American Rescue Plan Act. And none of that was renewed. So the child tax credit has essentially reverted to pre-pandemic levels. That's why all these changes have come into place. So last year, up to $3,600 for young children, up to $3,000 for children over the age 6. You had advance payments, so people were getting monthly payments July through December. It was great. Now this year, it is up to $2,000 per child, no advance payments per child, regardless of age, no advance payment. And then the amount that is refundable. Last year, the entire amount of that, the dollars that you were qualified for, was refundable, meaning if you had a certain amount of taxes due and you paid all those off, say through your withholdings, you could get the entire child tax credit in the form of your refund. It would be going right into your refund and right into your pocket. This year, not all of the child tax credit is refundable. If you've paid off your entire tax balance, maybe through your withholdings, maybe through other means, only $1,500 per child is refundable. So even if you're filing, you get your $2,000 per child, all your taxes are paid off, your child tax credit is reduced to that $1,500 per child refundable. And then finally, this one is hitting pretty hard too, is the earned income requirement. Last year, no earned income requirement to claim the child tax credit. You could be a non-working person and file your taxes all zeros under wages and still get the child tax credit and still get it all refunded to you. This year, earned income is required for the refundability of the child tax credit, that $1,500 per child, unless the taxpayer has 3 or more qualifying children. If there are 3 or more children in the household, you don't have to worry about having earned income. But for those who have fewer than 3 children in the household, you have to have earned income to qualify for it to be refunded to you, which means that, say, a grandparent who is only earning Social Security income, since it's retirement income that is paid out to you, is not considered earned income. It's not income from a job. It's not income from working at a business or self-employment. It's Social Security retirement income. So that retirement income is not considered earned income, and that maybe a grandparent who has 2 dependent grandchildren would not receive any refundable child tax credit. So those are all big changes that are hitting kind of hard. And for seniors who maybe have grandkids in the house, if you don't have any earned income, this one is going to hit pretty hard. So that's a big change to the taxes for 2022. I wanted to talk about another credit, and this credit is not as widely known. I think a lot of people kind of sleep on this credit, but it's the child and dependent care credit. This one has also changed a little for 2022, but I think a lot of people aren't claiming it to begin with. So I wanted to talk about it anyway. So the IRS allows you to claim costs for childcare if that childcare is what allows the taxpayer to work, look for work, or attend school. In 2021, they were allowing quite a lot. So you could claim up to $4,000 in expenses for one child or dependent, up to $8,000 for 2 or more children or dependents, and that entire amount was also refundable. Once again, if you paid off all the taxes IRS said was due, you could get all that right back in your pocket. This year, significantly lower, up to $1,050 in expenses for one qualifying child or dependent, up to $2,100 for 2 qualifying children or dependents. This year, though, it isn't refundable. But since this credit is required for taxpayer to work, look for work, or attend school, since it's not refundable, this can cut down on what that taxes owed are and might allow you to get your refund in the way of your withholdings or in the way of your other refundable credits that might be due to you. So if you are seeking childcare costs, I urge you to ask about this credit when you're getting your taxes prepared. Usually an EIN number or a social security number of who is providing care is required. The IRS has a lot of details about how to claim this credit on their website. But if you have any questions or you want to be directed towards that, please reach out to Ladder Up. We can explain it a little bit better. The next change is changes to the Earned Income Tax Credit, EITC, sometimes called EIC. This credit, very popular, very confusing. That's part of the problem is people hear about this credit and they go, oh my gosh, I get to get a credit just for earning income. I love it. I do too, but it's very confusing, the math on this credit. So we're going to try and go through it a little bit. But in 2021, for the pandemic reasons, they removed the age limit on this credit. In previous years, there was an age range that you had to be to claim this credit. So this is the one that's going to hit seniors a lot too. So that age range is older than 25 years old, younger than 65, the IRS's magic number, older than 25, younger than 65 as of December 31st, at the end of the tax year, to claim. So seniors over 65 and older who are working can no longer qualify for this credit. There is no way around this. It's just a flat age restriction. So that one is hitting a lot too. People are seeing much smaller refunds due to no longer qualifying for the Earned Income Tax Credit. After that, there's a maximum income threshold, and that of course is dependent on, what's our favorite thing? Filing status. So it also depends on qualifying dependents claimed. So 2 favorite things. So if you can see our charts below, the left one, the sort of lighter blue one, is showing yet last year's income limitations. So if you were a single filer, you maybe had 1 kid in the household, your income, the income that you had maxed out at that you no longer qualified for this credit was $42,158. And for this year, 2022, it's actually gone up in that circumstance a little to $43,492. But a lot of the people who are getting hit hardest by this change are single filers with 0 dependents, which you can see last year was $21,430 was the maximum. This year, that maximum $16,480. So we're seeing a lot of people no longer qualify for this credit because of that drop by about $5,000 in the maximum. So pay really close attention to how much money you made because, you know, more money during the year is probably better than a huge tax refund sometimes, but it is a surprise when people get to the end of that tax filing process and then they do not have the refund they were expecting or the refund they got last year because they had a couple of things that piled up on top of each other. Let's talk about the amounts of the earned income credit. So say you do qualify under these income thresholds that have changed for 2022. This is a refundable credit. So all of this does get refunded to you if you've already paid off the taxes for the year. But you can see an individual filer with no dependents last year, they would have got the maximum they would have gotten from this credit, 1,502. This year, the maximum they can get from this credit, 560. So they have really dropped this credit down. So I just want people to be aware, the seniors who no longer qualify for this credit, you're not going to see it in your refund. Those who are working and low income, this credit may have changed a lot for you as well. This is not something I want you to rely upon when you're getting your withholdings calculated. So keep that in mind, the earned income credit much smaller. And then let's summarize. So the first thing that's different about taxes this year compared to last year, no stimulus. Nobody got a stimulus in 2022, which was on taxes for people who did not receive their stimulus, called the recovery rebate credit. That one no longer available. That was giving people $1,400 last year if they didn't receive their stimulus, because IRS wanted you to get it in the form of your tax refund. Not anymore. It's gone. Filers with no earned income are no longer able to claim the earned income tax credit, and they're also no longer able to claim the refundable child tax credit. So this actually has taken a lot of people even from filing to not even filing, because they don't have income and they have no requirement to file and no benefit from filing. Seniors 65 and older do not qualify for earned income tax credit anymore, regardless of whether they did have earned income. This one is one that I'm more upset about, but c'est la vie. And then finally, we're going to see people who do qualify for the child tax credit, the earned income tax credit, and even the child and dependent care credit, significantly lower refunds due to the changes in those credits. They've just been brought down in the amount of money they're going to pay out. So keep this in the back of your mind when you get your taxes done this year. And if you want to get your taxes done this year with us, I have some good news, and we can cover what you would need. So what you're going to need to have your taxes done with us is your identification, your driver's license, your state ID, and social security card, so we can verify your social security number. You'll need all of your income documents from all of your jobs or retirement, W-2s, 1099s, 1099-Rs, which are the retirement ones, social security statements that you get at the end of the year, the 1099 social security statement. You will need bring, if you had any expenses or you qualify for any credits, you'll need to bring relevant information about that. Children's social security cards, education expenses, if you had children in K through 12, or if you had children in college, 1098E for college students, child care expenses, if you want to claim that child and dependent care credit, mortgage interest and property tax statements, and then if you're self-employed, business expenses. And then we have some locations all around the city and the suburbs. So I'm gonna I have a contact slide after this, but I think I'm gonna keep this one up for a little bit so you can write down what our walk-in sites are if you would like to. And I'm gonna cover some of the questions that we received initially before when you were signing up for the webinar. And then after that, maybe we can take a look at the chat and see if there's any questions. So let's start with number one I have is, can I claim work from home expenses on my tax return? This is a good question. If you're an employee, if you're considered a W-2 employee of your work, likely you cannot claim expenses from working from home because this is controlled by your employer. If you have the option to go back into work, largely you can't. There are certain deductions that people can take called non-compensated employment expenses. This is only the case if you itemize your deductions and if you have proof of what those expenses are and that your employer required you to pay for them, but in their handbook they say they won't reimburse. Let's talk about itemizing for a second. The numbers I gave you in who needs to file, the 12,900, those numbers, those they correlate with the standard deduction. The standard deduction is what the IRS gives to everybody as far as the first X amount of dollars you earn, we're not going to tax it. And that's dependent on your filing status, but let's use the single filer. So The single filer, $12,900, the first $12,900 they make, IRS is not going to charge taxes on that. Claiming the standard deduction is the easiest way to determine that amount. For those who may have expenses over $12,900, you can itemize your expenses and you can determine, you know, I paid for this and this and this and this, and I would like that deduction to be higher. The trick with this is you have to be able to prove it if IRS comes calling. So since the standard deduction 5 or 6 years ago was much lower, it was about $3,000. A lot of people itemized back then. Now that it's been raised to this 12,000 number, very few people, in at least that we see in our income range, need to itemize because they're getting more benefit from that 12,900 than from itemizing their deductions. So in the case of this person, you're working from home, maybe you bought a laptop, maybe you donated $500 to charity. Your itemized deductions would be $1,500 for a laptop, $500 for your charity donations, $2,000, which is not going to beat $12,900. So in that case, if you're an employee, no, you likely can't deduct those expenses for working from home. If you are self-employed, you can claim business expenses, and one type of business expense is called the home office deduction. The home office deduction has a lot of rules and regulations about it, and also is one of the most commonly misapplied deductions. So in the Cliff Notes version is if you are self-employed and you have a room in your house, which only you use for your business, and it is used for no other personal purpose at all, then you might be able to claim the home office deduction for self-employment. There are a bunch more rules about it, which can be found on IRS's website, or if you have questions, you can contact us at Ladder Up and talk to me about it. If you claim home office deduction, you are out of scope for our in-person services. It's just not something that we train the volunteers on. So you would have to use our ETAP program, or you would have to use a separate tax preparer. I would urge you to use a trusted tax preparer who really knows what they're doing as far as home office deduction, and make sure that you qualify before you claim it. That was a lot, but I want to be thorough. Next question I have is, are there any COVID tax provisions for tax filers? In the 2022 taxes, as we discussed, no, there's no longer any COVID provisions. They all expired. If you did not do your taxes for 2020 or 2021, we urge you to come in and do them. So either at our walk-in locations when they're slow, or at our ETAP program, which is doing 20 and 21, that you can still claim those COVID provisions if you did not file for 2020 or 2021. They are not available for 2022. We covered the home office deduction, but I had a repeat question. What kind of expenses can I deduct for working from home? Big popular one now that everybody is doing remote. I have one that is, if I have not received my W-2 or 1099 by the end of March, can I move forward in filing and then revise later? I do not recommend this because the IRS has a copy of your W-2 or your 1099 because your employer has to give it to you and to the IRS. This is how the IRS kind of determines whether you filed your taxes accurately. If you have not received a W-2 or 1099 from an employer, the easiest way to fix this is to call your employer and request another copy. If your employer is the type that they are not going to issue you a form, this is where maybe you've heard of paid under the table. This means that they're not accurately reporting your taxes to the IRS. They are under the table, right? Whether your employer is doing that or not, that's not something you can control, but you would essentially treat your income as cash income, as though you are self-employed with cash income if your employer is doing this. So you would get to claim business expenses, but you would have to pay self-employment tax. So if your employer doesn't at all issue you W-2s or 1099s, treat it as self-employed cash income. You still have a filing requirement. Your limitation there is $400. If your employer did issue one or does issue one, you need to request that before you do your taxes. File an extension if you need to. It's really easy. It's just a slip of paper, or you could do it online. Very easy to file an extension. Having to amend your taxes after you've submitted is difficult, and it doesn't maintain your rights if there's any audits. So the first tax return that gets filed, is the ideal one. We want you to file right the first time. So I would urge you instead to request it, see if you get it in time, file an extension if you need to. That'll extend the deadline for you till October. I have a question for, will the amount of my child tax credit be reduced if my 2022 income is too high? If for 2022, the child tax credit does have a phase out income. It is $200,000 for a single filer, $400,000 for married filing jointly, and that's for your modified adjusted gross income, not your gross income, your modified adjusted gross. So that's a technical, we won't get into that, but basically $200,000 is the phase out that you want to keep in the back of your mind. If you're married, $400,000. I would argue probably that most people watching this video are not at that level. You don't have to worry about the child tax credit phasing out due to your income. What you do have to worry about is not qualifying for it for other reasons, and the fact that it is only partially refundable this year. I had a question of, and I'm going to sort of paraphrase it because I don't want to get into too much taxpayer specifics, but what happens if somebody submits the child tax credit before I can? In this situation, two parents, one of the parents claims the kids ahead of time and files their return, and the other parent tries to file and claim the kids and gets rejected. It's not so much about the child tax credit claiming, it's about claiming the dependent, because a social security number or an ITIN number can't be claimed on multiple returns. That's just not allowed. So if this happens, it now becomes a dispute about who's able to claim the child and who's able to qualify for that child tax credit. This is something that we can help with in the tax clinic. This is called a false claims dependency issue. So what I would have you do is your e-file is going to get rejected. If somebody claimed your child before you, you are not able to e-file your return. You will mail that return to the IRS paper, and they will send you a letter saying, hey, we noticed somebody else claimed your dependent. At that point is when you will want to submit documentation to show that that dependent lived with you and that you were the one who was able to claim them. I would definitely have you reach out to the tax clinic here at Ladder Up, and we can either explain the process to you and what you will need to send in, or we can help you send those documents in together. So that's that one. And then I had another question I kind of want to anonymize a little bit, which is a disabled taxpayer who's living with their granddaughter, and they want to know if they can be claimed as a dependent by the granddaughter. This is just an example of a really personal situation. I don't know enough about your circumstances to give you the advice here on air, but I do want you to reach out, and I'll switch this over here. I want you to reach out to Ladder Up about your situation, and we can definitely give you advice when we know more about your specific circumstances and your granddaughter's specific circumstances. I wanted to pop over to see if we had any questions in the chat, but I don't think that we do. So that might be it as far as our presentation today. I'm not able to see the Facebook or the YouTube chats. If there is anybody who is asking questions on those chats, since I can't see them, I would have you reach out on the back end to the treasurer's office so that I can answer those questions afterwards, or to us at info@goladderup.org to get those questions answered.
Thank you so much, Michelle, for that informative presentation you provided us with today. We want to thank everyone for attending. We want to ask that if you have any questions, please feel free to reach out to the email that you see on the screen. Email info@goladderup.org for additional questions, or reach out to their team at 312-409-1555. Join us next month for Women's History Month as we bring the Triple M conversation with our own treasurer, Melissa Conyears-Ervin, joined by Melody Span Cooper of Midway Broadcasting and Melody Hobson of Ariel Investments. Again, this presentation will be available for replay on Facebook and on our YouTube channel, and we look forward to seeing you next month. And once again, thank you to Michelle Kuipers and the staff from Ladder Up for participating today. Thank you all, and have a great rest of your day.
Thanks, everybody.